Good morning, options traders, and happy Monday. And hopefully, we're off to a better start on Monday. I'm recording this on the weekend, so I can't even see the futures trading. I have no idea how we're about to open, but it's going to be an interesting one for sure. But it was a harrowing week last week on Thursday and Friday for anyone who is trading. Almost unprecedented moves, especially for back to back days. But I received some emails over the weekend where traders were saying, hey, I've noticed that obviously the put prices were going up when prices are crashing, but now I'm starting to see some very high implied volatilities in the calls. And does that mean that now traders are expecting the market to reverse? In other words, it appears that everybody is now shifting over to buy call options, and therefore the crowd seems to think that we're at a bottom. Well, is that really true? Do high call volatilities imply a reversal? So let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So to find the answer to this puzzle here, we have to start with our put-call parity equation. This is just a formula that shows that there's an intricate relationship between stocks, calls, puts, and the risk-free interest rate. And it's this formula right here that is really the foundation of synthetics. So if you've seen any of my synthetic videos, you're always going to see a variation of this formula. So it's an important one to know. But here's what it says. If we take the current stock price and we add, pick a put, doesn't matter which strike, doesn't matter which expiration, but if you subtract off the corresponding call, which means it has to have the same strike and expiration, you're going to find out that that is going to equal the current price of a T-bill if it were priced at this strike. So if we're looking at a $100 call and a $100 put, it would be the price of a $100 T-bill. So now, because these equal each other, the left side, these three pieces, stock, long, put, and short call, equal a T-bill, let's take the call and the put over to the right side. That's going to change their signs. We'll have long call and a short put. And then let's bring the T-bill over to the left. And that's going to change its sign to a short T-bill. So we're going to get this. And so now we can say that stock minus a T-bill, that this difference is exactly the difference between the call and the put. So let's work with this first part over here on the left-hand side. If we have stock trading for 100, risk-free interest rate is 5%, what is a 1-year $100 T-bill worth? What should it be trading for? Well, remember that a T-bill trades at a discount, doesn't pay any dividends, you just collect the face value at maturity. So the T-bill would equal, if it's a $100 face, we would divide it by 1 plus the interest rate. Remember, the interest rate is 5%. So if we divide by 1.05, it comes up to 95.24. And that tells you that the T-bill would be priced at $95.24 today. So if you pay $95.24 and you collect the face value of 100 in 1 year, you have, in fact, earned at the rate of 5%. So based on the previous formula, we saw that the $100 stock minus the T-bill equals 476. And that tells you, again from the previous formula, that the difference between the call and the put will be $4.76, no matter what the volatilities are. The call option has to be trading for $4.76 more than the put. Now again, that's assuming that they are the $100 call and put with 1 year till expiration and that interest rates are 5%. All right, so that's looking at the stock minus T-bill. That's the left-hand side of the equation. Let's look at the right. So we found, remember, that the difference between the call and the put is $4.76. So the thing to understand is that all volatility in the puts must be transferred to the calls. Or conversely, all volatility in the calls must be transferred to the puts. And it's because of this equation. They have to balance. So this email that I received, the person was making the argument, well, we know that everybody's been out buying puts. Nobody's buying calls. So the volatilities on the puts are just off the charts. Well, even if that were true, we know that the volatility for the calls must be off the charts as well. So let's consider a 1-year $100 call and a $100 put. So let's just pick some numbers. Let's say that the call is trading for $10. Again, this is the 100 call. We know that the put would be trading for $5.24. That's just 10 minus 476. So again, the call has to be $4.76 higher than the put. So what this person was assuming is that because the markets are crashing Thursday and Friday, everybody's out buying puts. And therefore the price of the puts will be rising. Maybe they're trading for 6 and then suddenly they're at 10 and then they're at 20. And therefore the volatilities must be through the roof. That's the only way that we could justify the put trading for 20 bucks that used to be trading for 5.24. It's got to be because of the high volatility. But once you understand put call parity, the point to see is that even if nobody is out there buying calls, which is never true, but just as an extreme example, and that everybody's out buying puts and it's only the put prices that are rising, what do we know must be true? So in this case, we can see that the call isn't trading for $4.76 more than the put. In order to keep put call parity in balance, the call must be trading for $24.76. Again, assuming that the put is trading for 20. Why? Because remember from the first slide, we saw right there that the difference in the call and the put has to be $4.76. So the call would have to trade for $4.76 more. So that was really the mistake that this trader was falling into. He was assuming that the price of puts were just going through the roof, and they were. And then he started doing some calculations on the calls and said, wow, the call volatilities are also super high. That must be because everybody's now buying calls and expecting a reversal. And that's really probably more just not paying attention. He was so focused on the puts and never really bothered to check the calls. If the put volatilities are through the roof, you can be 100% certain that the call volatilities must be through the roof as well, even if it were true that nobody was out even trading the calls. It's because of put call parity that those volatilities have to be transferred to each other. Now, is it possible we can get discrepancies? Sure, we could have a lot of put selling come in and push the puts a little bit lower, or maybe the calls a little bit higher. But the point is that maybe we see a difference that doesn't come up to be 476. In this case, it's a $5 difference. Well, how do you account for that now? Well, now this is a skew. And so if the stock price hasn't moved, what you would do is to say it has a higher implied interest rate. In other words, the market is now putting a risk premium on the risk-free rate. People don't want to trade this put-call parity equation at the risk-free levels. And so that can create a skew. But these differences aren't going to get super far out of line. Arbitrage is the reason, but they can certainly get a little out of balance. But the point to see, the main thing from this video is that if you are expecting put prices to be going through the roof because markets are crashing, then it must be the case that the call prices are also going through the roof. But that does not imply that people are expecting the markets to reverse. Be sure you understand the put-call parity formula, and you won't be led into making bad decisions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.